Greetings, traders, and welcome back. Thank you for joining me again, as always. Chris here, bringing you another survival guide. Today's subject will be bullish and bearish markets. We're going to talk about something at the core of all market activity, and this is something more for my newer traders. We're going to talk about exactly what it means to be in a bear market and exactly what it means to be in a bull market. We'll talk about their characteristics as well as some of the investment strategies that investors use to trade both of these particular scenarios. But without further ado, let's dive on into it so you can get all the information you need to pass that gauntlet mini. The very first thing that traders dipping their toes into the pool of technical analysis will find is they need to be able to identify whether they're looking at a bullish or bearish market trend. But what is a bullish and bearish market trend? The bearish market is a market that is declining, which usually takes place during times when the economy is in recession, kind of like what's going on now, and companies struggle. This is what happens when people are less confident in stocks and other things out there that they might otherwise be investing in, and as such, they're pulling their money out of them or just not buying them, which in turn creates overall selling pressure that is beating out the buying pressure, and as a result, we have the market dying. Now, there are two types of bear markets. We have a cyclical and long-term bear market. The former usually lasts more than a couple months, but the latter, the long-term, that can continue for years or even decades. Beginners often mistake a quick price drop for an overall bear market when in reality it might just be a temporary correction. Among the most devastating bear markets that we've witnessed, the king of all would be the Great Depression, which lasted 34 months. 34 months with an overall market drop of 86.1%. The dot-com bubble lasted about 30 months, and the markets fell by right around 49.1%. And with the financial crisis that we had during the housing market collapse, we saw around 56.4% of a market drop as well as a 17-month duration. So as far as those go, the only good thing we can take away from that is that each successive bear market event does seem to be lasting less and less long, which is good news because we are currently diving right on into one now, aren't we, with all of the COVID and everything else going on in the world. The thing is, though, bearish markets don't always have to mean doom and gloom with no opportunity to profit. That couldn't be farther from the truth. There are investment strategies that actually favor bearish markets. And as a matter of fact, during the financial crisis of 2008, there was a hedge fund manager that goes by the name of John Paulson, who you may have heard about, who made somewhere around $15 billion by shorting the market. It is possible to do this if you know what you're doing and are obviously on the correct side of the coin. But some of the most common investment strategies around profiting during bearish market events can be broken down into three categories. We have gold, stocks, and ETFs. With gold, it's a precious metal, and it has a negative correlation with bear markets. Gold is considered a safe haven asset, as many investors like to turn to it when the economy starts to struggle. Its value will usually increase when the market goes down and vice versa. When the economy is doing wonderful, sometimes we see gold plummet because we have value elsewhere. But when the economy and the stocks are not doing so great, naturally, we can turn to gold, something that isn't tied directly to a stock market because it's a physical commodity. It's something that has its own value due to its desire, or the desire of it, I should say, as well as its practicality. It's been around since the beginning of time and most likely will be around till the end of time. Then we have stocks. With stocks we can aim for the high quality ones, of course, during these bearish events. We want the shares of companies that have little debt with strong earnings and steady revenues. We can take into account the reason behind the bear market, as it will help us find potential opportunities to jump in during the downswing. So while the bear market in and of itself may not be an initial profit potential for us unless we're shorting the literal downswing, it can provide excellent buying opportunities for when the bear market is coming to an end. And the same thing applies to the ETFs. The ETFs are generally considered to be something sector specific. An example of this is if a recession hits hard and companies start cutting costs by decreasing their staff, a likely scenario is that they would invest in technology instead. You can consider ETFs on tech indices as a result. So once again, we can look at ETFs that are sector specific as a potential investment opportunity when the overall market may be tanking. And on the opposite side of the coin of the bear market, we have the bull market. And the bull market is usually what most of us favor because this is a market that is on the rise. During these times when the market is rising, a lot of times that means the economy is sound, the global political stage is calm, companies innovate, sectors flourish, and people have more disposable income to buy things. And as such, things grow in value. Bullish markets are usually an investor's dream because they are easier to navigate due to their lower volatility, and they usually can provide more favorable profit opportunities on a consistent basis. These type of markets are usually characterized by optimism and confidence. It's the opposite to the dark association that many view with the bearish market. There are no specific metrics to define exactly when we are entering a bull market. However, one key condition should be met. The prices of the certain asset that we're looking at or the whole market should be ascending. That means going upwards for an extended period of time instead of just marking a price jump that lasts a couple of days. Bullish markets usually are considered to have come to an end when the asset experiences a price drop of 20% or more. So once the market has a drop of 20% or more, at that point we're saying, okay, we may have switched hands from the bull market to the bearish market. There have been notable bull markets as well, just like we mentioned some of the notable bear market events as well. One of the most notable ones was from 1990 to March of 2000, the market had a 417% overall return. That is gigantic. This move parlayed into the longest ascending market in history when we pushed for about 134 months, only coming to an end in March of 2020 when we ran into COVID, where we are currently sitting. But from that entire period, from 1990 to March of this year, we saw returns somewhere around 350% for the S&P 500. That is gigantic. Just the same as there are strategies and ideas to keep in mind when investing in a bear market, we also have bull market specific ideas and strategies that should be applied as well. Some of these, to give an example, would be to focus on ETFs as well, but in a different asset. With ETFs or exchange traded funds, we can just buy the market. An ETF is literally an instrument that is going to be something like the S&P 500, which is a broad index and gives us a great overall exposure and diversification by itself. This way, this allows us to make profits just by position trading, where we're buying and holding for the long term. This is something that Warren Buffett has made extremely popular because it's one of the ways that he created a large portion of his wealth. Then we also have what to do with stocks. And with stocks, once again, because the market is bullish, the majority of industries are probably collectively doing well, and that means naturally that most of their share prices are going to be going up. So just like the ETF idea, we can look for stocks that are rising on the incline, but we can also try to be a little bit more specific and pay attention to things like tech stocks once there's a new breakthrough in a certain market sector, or we could pay attention to various other stocks whenever we're hearing more good bullish news and just continue to ride that overall climbing wave. Then we have what to do with commodities. And with commodities, same thing. A booming economy means higher consumption of just about everything. It It means more spending power and more consumption. As a result, commodities like corn, oil, and gas, they all tend to perform well during those bull market phases, and as such, we can look to invest in these types of things as well. Now that we've covered how to identify both bull and bear market phases, as well as talked about some strategies that we could potentially implement when trading them, we should probably cover how they are different. The first one is just going to be the fact that the economic and market conditions they describe are exact opposites. With our bullish market, obviously, we are going up, like we said, and with the bearish market, we are going down. So that's a pretty in-your-face difference right there. Then we have that they sit at the opposite ends of the spectrum. Investors and financial experts often use terms bearish and bullish to describe their sentiments towards particular securities or assets or the whole market in general. This sentiment is usually dynamic and can change depending on shifts in events or the analyst's expectation, news, and various other things. This is why many traders often consider the opinion of renowned investment professionals before they go ahead and make their own trading decisions for the long term. One of the metrics that helps them with this is by paying attention to the bull-bear ratio of most investors' views as a whole. It doesn't matter who you're getting your bull-bear ratio from, however, there are definitely some notable options out there that you may choose, but I'm not going to choose for you. But the idea is find people that you trust, find investors that you believe know what they're talking about, and then take a ratio of their bull-bear sentiment and see where you're viewing the market after that. Then we have the prevalence in the financial markets. And another difference between the bull and bear markets is their longevity. So although both the bull and bear markets can last for decades, the overall market direction has really always been upwards, thanks to innovation, the rise of new sectors and companies, and just overall growth. A rule of thumb is that no matter how long the market has been descending, in the end, it always breaks above its pre-crisis level. And to confirm this, we can just simply take a look at history. We can look at the Depression like we talked about, recessions, wars, global political instabilities. All of this has always been the outcome. Since the S&P 500 was created in 1957, it's grown over 5,800%. Then we also have the investor behavior during both situations. And this is another way that they are different because during bearish market periods, investors are less confident in the profit opportunities and tend to be less active in general. One of the main reasons is that the volatility itself is increased with bearish market activity due to uncertainty. And to overcome this, investors focus on asset classes that can preserve their wealth and avoid finding unnecessary extra risk, which is what ties us back into why investors may favor things like gold and bonds during those bearish market phases. But on the other hand, in bullish market periods, investors adopt a looser approach and actively will seek profit opportunities. So this is another way that the two bull and bear markets differ. As far as the similarities go, we don't really have to spend too much time here because a lot of these are just more common sense. The idea is that both markets provide opportunities to make money. So both markets do provide opportunities to profit. If we short a falling market, we'll make money. If we long a rising market, then we'll make money. Both markets are inevitable. We're going to go up and we're going to go down at some point or another. And both of them are identified through technical analysis. We identify whether the market is going up or down by paying attention to the historical path of price. And finally, they are both equally powerful in their influence on the market. They influence the market slightly different with the way people respond to them, but both of them have heavy reactions to the investing world. To make sure some of the information that we've covered sticks in, we're going to go through some frequently asked questions as far as bearish market situations go. The first one is, what sectors do well in a bear market? This is the most common question by far, and the bear market is usually favorable to sectors like mining due to gold status. Obviously, they're considered to be a safe haven asset. And then we have material producers that are usually good investment choices during bearish markets. Things like consumer goods and retails, other things along the lines of discount stores during bearish market events will always be a nice opportunity because during the the bearish market phases, people are usually looking to save money instead of spend it. Then we have a question that says, can you make money in a bear market? And the simple answer here is absolutely yes. That is what we talked about. Just like we said, there are things that become good buying opportunities during the bear market, or we can just simply ride the market down in general. And number 3 is it good to invest in a bear market? Well, if you know what you're doing, it is always going to be subjective. So whether or not you feel comfortable investing in a falling market is the first thing you have to ask yourself, and whether or not you have the proficiency and the understanding to be able to profit in a falling market and deal with the extra volatility is something else you need to ask yourself. And finally, we have what is the longest bear market in history, which occurred during 1946 and lasted for 37 months. It was caused due to the increased stock market boom that was as a result of all the increased production and demand that occurred during wartime after war was over. This is something that we have seen historically happen throughout many countries during times of war. All of the jobs that were needed for the war efforts are all of a sudden gone once the war is gone. As far as bullish frequently asked questions go, we do have a few here for you as well. And the first one is, how does buying on margin help reinforce the bull market? Well, buying on margin basically means that we're multiplying our purchasing power. More buying, more bullish activity. In short, that is the easy way to understand it. So buying on margin just means we're buying more. Number 2 is, what is a bull market run? Well, a bull market run is an extended period of time when the economy is sound and the market is rising. What is a secular bull market? Well, a secular bull market is a term that you don't hear entirely too often in general, but it describes a sustainable and powerful force that can remain in place for decades. This means that the prices of the market or a particular asset can mark above average returns for a period of 10 or 20 years. So a secular bullish market can be interrupted by a short-term bearish move, but always proceeds to mark even higher as it chugs along. And then we have what is the longest bull market run in history, which we covered in the very beginning, and that was from the period of 2009 to 2020 when we saw the S&P grow over 348%. In conclusion, we have bullish markets that rise, and we have bearish markets that fall. Both of these have the opportunity for us to profit as long as we understand how to correctly identify which type of market scenario we are in. That way, we can ride the overall momentum. But remember, with the bearish market, the volatility is increased, so be prepared to deal with that or incorporate that into your trading strategy. As far as the bullish market goes, we don't want to get scared out or spooked by a drawdown as the market continues to chug along in the bigger picture. But until next time, folks, make sure you do your studying if you think you have what it takes to pass the Gauntlet Mini, and good luck to those of you that are, but I will see all of you very soon. Over and out.